Hey everyone, and welcome back to Simple Mind Space. Today, we're diving deep into a fascinating world where physics, math, and finance collide. A world where a single equation has given birth to multi-trillion-dollar industries and revolutionized how we perceive and manage risk. Buckle up because we're about to explore the captivating story of how physicists and mathematicians cracked the code of the stock market. Now, you might be wondering, derivatives? What are those, and why should I care? Trust me, they're more significant than you might think. Most people don't fully grasp the sheer scale and influence of derivatives in our financial system. These financial instruments, born from an equation rooted in physics, impact our lives in ways we might not even realize. Think about it. This equation's journey began with the quest to understand the universe's building blocks, atoms. It then played a crucial role in unraveling the mysteries of heat transfer. And believe it or not, it even helped people gain an edge in the game of blackjack. So it's only natural that some of the most successful figures in the stock market weren't seasoned Wall Street veterans, but brilliant physicists, scientists, and mathematicians. Let's talk about Jim Simons, a name synonymous with success in the world of finance. In 1988, this math whiz established the Medallion Investment Fund, a fund that defied expectations by consistently outperforming the market year after year for 3 decades straight. We're not talking about small victories here. This fund generated an astounding average annual return of 66%. To put that into perspective, imagine investing a mere $100 back in '88. Today, that investment would be worth a jaw-dropping $8.4 billion. This phenomenal success story catapulted Jim Simons to the coveted position of the wealthiest mathematician in history. However, as history has shown us, being a math genius doesn't guarantee success in the unpredictable world of financial markets. Take the legendary Isaac Newton, for instance. By 1720, Newton, at the ripe age of 77, had amassed a considerable fortune through his illustrious career as a professor at Cambridge and his role as the master of the Royal Mint. His net worth, a substantial £30,000 at the time, would be equivalent to a cool $6 million today. Eager to grow his wealth further, Newton decided to dabble in the stock market. One of his most significant investments was in the South Sea Company, a company that profited from the transatlantic slave trade. With the business thriving, the company's share price soared. By April 1720, Newton's investment had doubled in value, prompting him to cash out. However, the stock price continued its upward trajectory. Enticed by the prospect of even greater profits, Newton jumped back into the fray in June, buying more and more shares even as the price reached its peak. When the inevitable market correction occurred and the price began to plummet, Newton, instead of cutting his losses, doubled down, convinced that he was capitalizing on a temporary dip. But the rebound he anticipated never materialized. Newton's losses mounted, ultimately costing him a staggering third of his wealth. When questioned about his misjudgment, Newton, reflecting on the unpredictable nature of human behavior, famously remarked, "I can calculate the motions of the heavenly bodies, but not the madness of people." This begs the question, what did Simons grasp that eluded even the brilliant mind of Isaac Newton? One crucial difference lies in Simons' ability to learn from those who came before him. He recognized the groundbreaking work of Louis Bachelier, a pioneer in applying mathematical principles to understand financial markets. Born in 1870, Bachelier's life was marked by early tragedy, losing both parents at 18. Forced to take over the family wine business, he eventually sold it and moved to Paris, seeking a career in physics. To support himself and his family, he found work at the Bourse, the bustling Paris stock exchange. Inside the chaotic world of the trading floor, amidst the cacophony of shouting traders, Bachelier found himself captivated by a specific type of financial contract, known as options. The earliest recorded use of options dates back to 600 BC, when the Greek philosopher Thales of Miletus made a brilliant financial move. Thales, predicting a bountiful olive harvest, saw an opportunity to profit. He could have invested in olive presses, knowing they'd be in high demand, but lacked the capital for such an endeavor. Instead, he approached olive press owners, paying a small fee to secure the right to rent their presses during the harvest season at a predetermined price. As fate would have it, Thales's prediction was spot on. The olive harvest was plentiful, sending the rental price of olive presses soaring. Thales, having secured his options, rented the presses from their owners at the agreed-upon lower price and then leased them out at the prevailing higher market rate, reaping a handsome profit. This ingenious move marked the birth of the call option. A call option grants you the right, without the obligation, to purchase an asset at a specific price, the strike price, on or before a specified date. Conversely, a put option gives you the right to sell an asset at the strike price. While call options are profitable when you anticipate a price increase, put options come in handy when you expect a price decline. To illustrate, suppose Apple stock currently trades at $100 and you predict a price surge. You could acquire a call option for $10, giving you the right, but not the obligation, to buy Apple stock at a strike price of $100 1 year later. If, after a year, Apple's stock price skyrockets to $130, you can exercise your option, purchasing the shares at the predetermined $100 and immediately selling them at the market price of $130. Factoring in the $10 cost of the option, you'd walk away with a tidy $20 profit. However, if the stock price plummets to $70, you simply choose not to exercise your option, limiting your loss to the initial $10 premium paid. Options offer several advantages. First, they limit your downside risk. Had you purchased Apple stock outright instead of the call option, a price drop to $70 would have resulted in a $30 loss, potentially even a complete loss if the stock price plummeted to zero. Second, options provide leverage. In our Apple example, your investment grew by 30% if you had bought the stock. However, by utilizing options, you only needed to put up $10, resulting in a 200% return on investment with your $20 profit. The trade-off? Higher risk. Had the stock price plummeted, your losses would have been magnified. Finally, options serve as a hedge against potential losses. Imagine you own a significant amount of Apple stock and worry about a market downturn. Buying put options allows you to lock in a selling price, protecting you from a substantial loss if the stock price were to crash. Back in Bachelier's time, the trading floor was a chaotic place, especially when it came to pricing options. Despite their long history, no one had devised a reliable method for determining their true value. Prices were determined through haggling and guesswork. Bachelier, with his keen mathematical mind, believed there had to be a more scientific approach. He proposed tackling this challenge as his PhD thesis, much to the surprise of his advisor, Henri Poincaré, who, despite the unconventional nature of the topic, agreed. The first step in accurately pricing an option, Bachelier realized, was understanding how stock prices fluctuate over time. Stock prices are essentially driven by the forces of supply and demand. When demand outweighs supply, prices rise. When supply exceeds demand, prices fall. However, countless factors influence this delicate balance. Economic indicators, political events, natural disasters, technological advancements, and even investor sentiment. Bachelier, recognizing the near impossibility of predicting all these variables with precision, made a groundbreaking assumption. At any given moment, the probability of a stock price going up or down is equal. This led him to the concept of the random walk, a model where stock prices meander up and down as if their movements were determined by the flip of a coin. To grasp this concept, imagine a Galton board, a triangular arrangement of pegs with tiny ball bearings cascading through them. Each time a ball strikes a peg, it has an equal chance of bouncing left or right, its path a perfect example of a random walk. While predicting the trajectory of a single ball is practically impossible, something fascinating occurs when thousands of balls flow through the board. A pattern emerges, a bell-shaped curve known as a normal distribution. Most balls cluster around the center, as there are countless paths leading there. As you move further from the center, fewer paths exist, making those outcomes less likely. Bachelier envisioned stock prices behaving like balls on this Galton board. Each row of pegs represents a time interval. In a short period, the stock price can only move up or down by a small amount. However, as time progresses, the range of possible prices expands, forming a normal distribution centered around the initial price. Unbeknownst to Bachelier, he had stumbled upon the same equation used to describe how heat dissipates from hotter to colder regions, a phenomenon first explained by Joseph Fourier in 1822. Bachelier, drawing parallels between heat diffusion and the spread of probabilities, dubbed his discovery the radiation of probabilities. Sadly, Bachelier's work remained largely unnoticed. The physics community, unfamiliar with the intricacies of finance, paid little attention. Meanwhile, traders, accustomed to their intuition and experience-based approach, weren't quite ready to embrace the power of mathematics. What was missing was a tangible demonstration of how this equation could generate significant profits. Fast forward to the 1950s. Enter Ed Thorpe, a young physics PhD graduate with a knack for spotting opportunities. While pursuing his studies in Los Angeles, Thorpe couldn't help but be drawn to the allure of Las Vegas, the burgeoning gambling mecca, just a few hours away, and he saw a way to beat the odds. Thorpe set his sights on the blackjack tables, a game where, at the time, dealers used a single deck of cards. As the game progressed, Thorpe, with his exceptional memory, meticulously tracked the cards that had been dealt. This meticulous card counting allowed him to calculate the probability of winning or losing on each hand. He bet strategically, increasing his wager when the odds were in his favor and holding back when they weren't. This ingenious system, unheard of at the time, turned Thorpe into a formidable force in the casinos. However, the casinos, realizing the threat posed by Thorpe's strategy, adapted, adding more decks to the game to diminish the effectiveness of card counting. Undeterred, Thorpe, armed with his winnings and a newfound understanding of probabilities, set his sights on a new target, what he dubbed the biggest casino on Earth, the stock market. He established a hedge fund, aiming to replicate his blackjack success. His strategy? Applying the principles of probability and risk management he had honed in the casinos to the world of finance. Thorpe's hedge fund thrived, generating an unheard of 20% annual return for 2 decades, a testament to the power of his approach. Thorpe's true genius lay in his pioneering of hedging, a technique to mitigate potential losses by making offsetting or balancing transactions. Imagine Bob sells Alice a call option on a stock. If the stock price goes up, making the option profitable for Alice, Bob stands to lose money. To counter this, Bob buys a unit of the underlying stock. Now, if the stock price rises, his loss on the option is offset by the gain in the stock's value. If the stock price drops, making the option worthless to Alice, Bob sells the stock, minimizing his risk. This is the essence of dynamic hedging. Thorpe, never one to rest on his laurels, recognized a flaw in Bachelier's model for pricing options. Bachelier's model assumed stock prices followed a purely random walk, ignoring the inherent upward or downward trends that characterize markets over time. To address this, Thorpe developed a more sophisticated model that incorporated this drift in stock prices, making it more accurate and effective for predicting option prices. He kept this refined model a closely guarded secret, using it to identify undervalued and overvalued options, buying or short-selling them accordingly. This strategy proved incredibly lucrative until 1973, when a groundbreaking equation emerged, forever changing the landscape of finance. In that pivotal year, Fisher-Black and Myron-Scholes unveiled an equation destined for greatness. Robert Merton, working independently, developed a similar equation based on the principles of stochastic calculus, sharing credit for this revolutionary breakthrough. Black-Scholes and Merton, like Bachelier before them, believed that option prices should represent a fair bet for both buyers and sellers. However, their approach was refreshingly novel. They posited that if one could construct a risk-free portfolio comprising both options and the underlying stock, a strategy Thorpe had already implemented, then in an efficient market, this portfolio should yield no more than the risk-free rate, the return one would expect from investing in the safest asset available, typically U.S. Treasury bonds. Their logic was simple yet powerful. If no additional risk is being taken, it should be impossible to generate returns exceeding the risk-free rate. To describe how stock prices behave over time, they built upon Bachelier's model, acknowledging the inherent randomness, but also incorporating the concept of drift. The result? The most famous equation in finance, the Black-Scholes-Merton model. This elegant equation provided a way to calculate the theoretical price of any derivative contract based on any underlying asset, stocks, bonds, commodities, you name it. The same year this equation was published, the Chicago Board Options Exchange was established, marking the birth of a new era in finance. So what made this equation so groundbreaking? In essence, it offered a precise, mathematically sound method for determining the fair value of options. Previously, traders relied on intuition and guesswork. The Black-Scholes-Merton model provided a clear-cut formula where you plug in the relevant parameters, the current stock price, the strike price, the time to expiration, the risk-free rate, and a measure of the stock's volatility, and out pops the option's theoretical price. This breakthrough led to the rapid adoption of this model by Wall Street. Within a few years, it became the gold standard for trading options. The exchange-traded options market exploded, growing exponentially into a multi-trillion-dollar industry. This phenomenal growth, often referred to as the financial equivalent of Moore's Law, extended to other areas of finance, including credit default swaps, over-the-counter derivatives, and securitized debt, all multi-trillion-dollar industries built upon the foundations laid by the Black-Scholes-Merton model. This equation's impact went far beyond theoretical pricing models. It provided tools for hedging against a myriad of risks, not just for Wall Street giants, but for businesses of all sizes, governments, and even individual investors. Consider an airline concerned about rising fuel costs. The Black-Scholes-Merton model provides a way to accurately and efficiently hedge this risk. They could, for example, purchase options on oil futures contracts. If oil prices rise, these options would increase in value, offsetting the increased cost of fuel. While the Black-Scholes-Merton model offered a powerful tool for managing risk, it also opened up new avenues for speculation and leverage, as exemplified by the infamous GameStop short squeeze of 2021. In a nutshell, a group of retail investors on the Reddit forum r/Wall Street Bets decided to challenge hedge funds that had heavily shorted GameStop stock, essentially betting on the company's decline. They bought massive amounts of GameStop stock and, crucially, call options, amplifying their buying power. This coordinated effort sent the stock price skyrocketing, inflicting significant losses on the hedge funds caught on the wrong side of the trade. The GameStop saga highlighted both the potential and the risks associated with leveraged trading in the options market. The world of derivatives, born from a single equation, has grown to an astounding scale, with estimates placing its size at hundreds of trillions of dollars, a figure dwarfing the value of the underlying assets on which these contracts are based. While this might seem paradoxical, it reflects the leverage and risk transfer capabilities inherent in derivatives. So, has this explosion of financial innovation made our financial system more stable or more susceptible to crashes? The answer, as with most things in finance, is nuanced. During calm periods, derivatives provide liquidity and facilitate risk management, contributing to stability. However, in times of market turmoil, these instruments can act as amplifiers, exacerbating losses and potentially triggering cascading failures. The 2008 financial crisis, where the misuse of complex derivatives played a significant role, serves as a stark reminder of the potential downsides. In recognition of their groundbreaking work, Merton and Scholes were awarded the Nobel Prize in Economics in 1997. Sadly, Fisher Black, who passed away 2 years earlier, wasn't there to share the honor, though his contributions were acknowledged. The widespread adoption of the Black-Scholes-Merton model presented a new challenge for hedge funds seeking to outperform the market. If everyone was using the same model, finding profitable opportunities became increasingly difficult. This is where Jim Simons and his data-driven approach come into play. Simons, a highly accomplished mathematician with a background in code breaking during the Cold War, believed that machine learning held the key to unlocking hidden patterns in the stock market. He recognized that markets were far too complex for human intuition alone to consistently predict. Simons, drawing upon his experience deciphering coded messages by identifying patterns in vast amounts of data, believed a similar approach could be applied to financial markets. In 1978, he founded Renaissance Technologies, a hedge fund determined to crack the code of the stock market using data analysis and algorithms. Simons assembled a team of brilliant scientists, mathematicians, and programmers, prioritizing raw intellectual horsepower over financial experience. Their mission? Find subtle, often fleeting patterns in mountains of financial data. One of the key tools in their arsenal was the hidden Markov model, pioneered by Leonard Baum, a member of Simons's team. Hidden Markov models excel at uncovering underlying factors that, while not directly observable, influence the data we can see. Think of it like trying to deduce the weather based on how people are dressed. You can't directly observe the weather, but you can infer it from the available information. Renaissance Technologies' flagship Medallion Fund, leveraging these advanced techniques, became a legend in the world of finance, consistently delivering extraordinary returns, challenging the very foundations of the efficient market hypothesis. The efficient market hypothesis posits that stock prices reflect all available information, making it impossible to consistently outperform the market. The Medallion Fund's success, however, suggests that inefficiencies, however small and fleeting, do exist and can be exploited with the right tools and expertise. This brings us to a fascinating question. What happens if we manage to identify all the patterns in the market? Paradoxically, the very act of discovering and exploiting these patterns would ultimately lead to their disappearance. As more market participants act on this knowledge, prices would adjust, eliminating the arbitrage opportunity. In essence, we would have achieved a perfectly efficient market where all price movements are truly random. As we've explored the intricate dance between physics, math, and finance, we've witnessed how groundbreaking discoveries, often born from seemingly unrelated fields, can have a profound and lasting impact on our world. From the random walk of particles to the complex world of derivatives, these innovations have reshaped how we perceive risk, invest our money, and build our financial systems. So, the next time you hear the term derivatives or algorithms in the context of finance, remember the fascinating journey that led to their creation, a journey that began with the pursuit of knowledge, fueled by ingenuity, and forever changed how we navigate the uncertain waters of the financial world. And that's it for today's deep dive. If you enjoyed this exploration of the fascinating intersection of science and finance, don't forget to like, share, and subscribe to Simple Mind Space for more thought-provoking content. Until next time, keep those minds curious.